Welcome to the daily update, where I'll go over the action in the market for Thursday, June 20th, and then we'll see how things look for Friday, June 21st. Before I start, happy summer. Depending on where you live, it may have already started on the 20th. It may not have started yet on the 22nd. A good time for baseball, barbecues, and beach. So, wishing everybody a really happy and safe summer. Also, please know that the SPX Investing Program has launched. It's free for the month of June. We're kind of closing into July now. That's when I'm going to start locking things down and actually rolling out some additional things. Even after this starts, you'll still have a 30-day free trial, but I'm going to be locking it down because there are other things that I don't necessarily want public that are out there. And it goes way beyond just the videos that I do here. And you have access to a lot more things, including group discussions and conversations with me, either through Zoom or Skype or Messenger or whatever you use. If you're more interested in learning about the program, there are links in the description below the video. I have a playlist on YouTube that you can watch, and there's also a link to go check out the website itself. Let's go back and talk about what happened. We did have a higher open. The futures were quite positive. It was really one of those weird times because we were closed on Wednesday, one of those midweek off days, and it's kind of thrown things off a little bit. But the futures were pretty solid and got more solid. Europe ended up having a pretty good day. And so the US markets kind of keyed off of that a bit. But we did have a higher open and prices climbed above R1 at 54.95. And we got up to R2 at 55.02. So now we're starting to deal with that 5,500 level. That ended up setting the high for the day. We fell back down from that, but the fact that we're just getting up to that level could be rather encouraging. We fell back down below R1. We went down to the unchanged level, and then we actually went negative after that. We fell below the daily pivot at 54.83, below S1 at 54.75. We tried to find support at just a little bit below S2 at 54.64. Then we rebounded back up to the unchanged level, and then prices fell back and closed slightly below S1. So it was a rather choppy day. We didn't see a lot of intense selling into strength, but it was a more negative day when you look at the price action. But internally, we're actually seeing things improve a little bit, and I'll go through that. We were down 0.25% on above average volume, so that has still been healthy lately. We're positive in the short, intermediate, and long term. We're overextended, or you could suggest good momentum in the short term. Still seeing negative divergences in the intermediate term, but they could be showing some signs of improvement even on a down day. Long term, also a few negative divergences with those long-term moving averages, but still looking positive as the market tries to work through this inflation and interest rate scenario. And we just want to be aware of all the different geopolitical things going on. Some comments. Mega caps underperformed. There was some profit taking. We'll have to look at some of these charts when I go through the individual ones to see, are we turning more negative here, or is this just some profit taking after having a nice run to the upside? The negative divergences, they're still there, but are we seeing some signs of improvements? The short-term list is still long. It really hasn't changed. It's worked its way down a little bit from those extreme readings, but it's still extreme nonetheless. With the Stochc RSI, the Williams percent R, the CCI 14 and 20, the stochastics, the RSI 9, and the boom indicator based on 20 periods, still have a pretty long list in the intermediate term with the standard deviations chart, the CMB composite, the Sean trend meter, Chaikin oscillator, ultimate oscillator, and the boom indicator based on 50 periods, and then the more intermediate term RSI based on 14 periods. I haven't changed the scenario here. The Fed is keeping rates higher for longer because inflation hasn't been coming down the way they want. And now it's looking like they may have the potential of a rate cut in September, but that's just what the market is fixating on right now. As each day plays out, and more economic reports come out, we'll see if that ends up actually changing. Now it looks like, if anything, we're looking at one rate cut in 2024 rather than three, which of course is down from the 6 that we saw at the beginning of the year. The dollar was up and interest rates were also up. This pressured stocks as well. We're at 4.25% with the 10-year yield, where we had been at 4.22%. We're still inverted with the yield curves. Sentiment is negative. We ticked down with the down day. We're at 40. This is very strange, having the S&P 500 near all-time highs and sentiment is actually negative and declining. It's because of these negative divergences that we're seeing. We are in a confirmed trend with our ADX. So we're above the moving average. The green line is on top, and it is showing an improvement there. With the down day, I've switched the bias to negative. That's usually if we have an up or a down day. And then the momentum, the last number of days, we're still positive overall. We did get weekly initial jobless claims, came in pretty much as expected at 238,000, up 1,000 from the 237,000 they had expected. Last week, it was at 243,000, so a little bit lower than last week's reading. Continuing claims are also up a bit at 1.828 million. Last time it was at 1.813 million. Housing starts weaker than expected. This can be a leading indicator at 1.277 million. They expected 1.385 million, and also down from the 1.352 million we saw last time. Building permits also came in a bit weak at 1.386 million. They expected 1.455 million, and down from the 1.44 million we saw last time. I don't have a chart of the Philadelphia Fed index. It came in with a reading of 1.3, much weaker than the 6.5 they had expected, and also down from the reading we saw last time of 4.5. The first quarter current account balance, it was actually greater than expected, meaning the deficit was greater at a minus 237.6 billion. They expected it to be a mere 203 billion. Last time it was at 221.8 billion. Here are some charts showing housing starts and building permits. This is a 3-month average, and then they project it out on a seasonally adjusted annual rate. So we are declining here, and this could suggest some weakness going forward economically. We're seeing the starts, which is the blue line, going down, and the building permits going down. And you have to do these things first, the starts and the building permits, before you can even start anything. So that's why these tend to be leading indicators. Here's the reading that we're reading here, where it's down a little bit over in the latest bar that we're seeing here. Weekly jobless claims were down, but we're still seeing the 4-week moving average going up. And this is suggesting some weakening in the employment situation. Continuing claims are also going up, and the moving average is going up. So we're keeping an eye on this. When we put these together, the red line are the initial claims, the blue line are the continuing claims, and then we had the latest reading at 4% of the unemployment rate. This is a further blow up of that same chart to give you a little bit of context. Some Isabel Net blog charts. This is just showing the cumulative change in real dollars, which means it takes inflation into account. This is a chart that we see every once in a while, and they're also comparing it with real profits. And you see other times when the blue area is above, then this can lead to some negative action after that. When it's below, even though we might be going through difficult times, a lot of times that can lead to some positive action. Now, this is much longer term. And where we're at right now, we're seeing the blue line above. And so we're thinking, is this at some point longer term going to have an impact on the S&P 500 and their profits? Then here is another way of looking at a weekly chart of the S&P with the 40-week moving average. I do show that in the weekly video, and we also have some 200-week. Now, to me, this is the ultimate long-term trend, and we've been above that since 2009. And in some ways, you can go back even further than that. But this just means the really, really big trend still continues to be positive when you look at the 200-week moving averages. They draw a cup and a handle here, which tends to be positive for the S&P going up. They also have some projections going out forward here. Now, this is how things are looking as of the week so far, and it's continuing to look positive. You see that we're in an uptrend overall here. Then cash levels are still quite low. That means that folks that want to actually put money from a money market into the stock market, those levels are low right now. They're deploying an awful lot of that money. And then the earnings revisions for 2024, where it's a few stocks that are really leading the overall market right now, where this gray area, that's topics up here. And then we have the light blue line, which is the stock 600. That's more Europe. And then topics is more of Japan, I believe, if I have that right. And then we have emerging markets, which are still looking a little bit weaker here. And then the dark blue line is the S&P 500. The probability of a recession as it was priced on June 13th across the equity, credit, and rates. So the S&P 500, 0%. That's the one chart that I show you. I don't have it today, but where we look at a ratio between the S&P and bonds, and it's predicting a soft landing. So there's really no prediction there. When you get in to this high grade, more conservative type of credit, a little bit higher than high yield, these are more junk bonds. Then we get into the 5-year yield and the base metals over here, and then the small caps over here. They're showing the potential of going into a recession is a lot greater than what we're seeing in bonds and in stocks. We did get retail sales earlier in the week, and we're keeping an eye on this chart because a lot of times when this level, which gives us real retail and food services sales. Real, again, means that inflation is taken into account. When this starts to flatten out, a lot of times that can lead up into a recession. We saw it flatten out here, and then things really went down. We had that very short negative GDP back in 2020 before the whole COVID crash. And then the COVID crash, of course, happened after that. Well, we continue to level out here as retail sales, which are a huge part of the U.S. economy. I've seen anywhere from 50 to about 70% of what happens in the U.S. economy has to do with retail sales. So we're not necessarily at a recession yet, but this is one of those charts that we're keeping an eye on because you can make a case for either side. You can show charts that say, yeah, we're going to go into a recession. You can show other charts that say, no, we're not. Then where are people putting their money right now? They are going into equities, which means stocks. The Eurozone tends to be rather positive, even though the debacle in France, at least according to the stock market, that seems to have kind of gone away now. They're getting more defensive with healthcare stocks, but people really like tech stocks, the bank stocks. And then in the US itself, as well as commodities, Japan, which is still near all-time highs, and then the industrials and emerging markets, where you have a lot of the more defensive areas, staples, of course, cash, energy, which goes back and forth between defensive and offensive. In the UK, not very positive there right now. Bonds are still negative based on price. Utilities are going out of favor now. And then real estate investment trusts, seeing a lot of money coming out of that. Just gives you an idea on a global basis of where the money is going to. I found this chart. This is from David Keller from stockcharts.com. And he showed this in one of his videos, and he also posted this chart on Twitter. And this is kind of the approach that I take, although I might include another line here, which is more of a flat line for a sideways market. But this is what we're trying to evaluate on a day in and day out basis. The number one scenario is that we're going to continue with the uptrend. Then that's kind of what's been happening here. Now, this is the QQQs. We can put this same kind of approach here on the S&P 500. That's why I chose this chart. If we see a mild upward move, that would be number two. I would put a flat line in here for sideways. Then we go down here to his number three, which we see a slight decline. And then down here would be where we're seeing a more intense decline. And that's what we're trying to evaluate from day in and day out, watching all these different charts and all the different indicators that we use. This is kind of interesting. This is more based on seasonal changes where the 2021 highs took place right at, see, they kind of wrote it up a little different way, the first day of winter. Now they're using the equal weight here. So this is not as strong as what the S&P 500 has been doing. So we set the low here back in 2020, and then up here in 2022, this is when we set the highs. It has to do with the change of seasons. Then we set another low here, and then are we possibly setting a high at this place? So just kind of keeping an eye on this. We're coming into summer now. Is that going to mean anything? A lot of times when a bunch of people focus on something like this, it ends up being a non-event. But I just thought this would be interesting. Here's our intraday chart. It looked like we were going to have a nice solid day, at least start off that way. We gapped higher above R1. Now, because Tuesday's session was so anemic, that put the pivot points really close to each other. So we got above R1, actually a little above R2, but that set the high before we came back down below R1. We came down to the unchanged level. It held for a little while, but then we broke below it, broke below the daily pivot, below S1, came down to S2. That held. Then it looked like, oh boy, are we really going to even break further to the downside? But didn't see an awful lot of follow through. We saw a lot of buying coming back in, took us back up to the daily pivot. We went down back below S1 and we closed just a little bit below S1. So it's kind of a choppy day as far as the pivot points and our different actions above and below the unchanged level. Nothing really all that big here to show you in this pink area. This is what the futures were doing before the market opened, and they were actually looking a lot better. And then we initially shot up right at the open, only to give a lot of that back. We're still looking good here. This is our intraday chart of large cap growth versus value, and I even extended it back a little bit further. The blue line is above the red line, so that is showing some strength. We're also seeing a little bit of weakness here, but again, if you look at this in the bigger context, going back to the beginning of June, we have been seeing a really nice rise here, but we did see some pullback on Thursday with the growth to value ratio intraday. So we were down with growth where value was up. The mid caps were down more and the small caps were down more. So growth took a bit of a hit on Thursday. So we're going down a little bit with our small cap growth to value, mid cap growth to value, and even a little bit down, which this was looking better with the S&P growth to value ratio. It still had been breaking out above these previous points, and that for right now is positive. We want to see this turn and go back up to stay more positive with this. We came down a little bit when we look at the growth to value ETFs, but we're still breaking out above the rainbow. Discretionary kind of chopping sideways right now. Saw a little bit of a tick up in staples. So when you do the ratio between the two, we actually turned up a little bit, but we're not really breaking out here with discretionary versus staples with this ratio. Large cap growth just coming off of setting a recent all-time high. The large caps continue to outperform the small caps. And the Wilshire, another broad market index, just coming off of a recent all-time high. Our trend is still positive because the green line's on top, even though it did decline. Now, the ADX is above its moving average, and both are above 20. So that is a confirmed trend, and it's a positive trend with the green line on top. And pretty much that same thing here in our shorter term version of this chart. We are picking up with volume, and that, for right now, it just seems like there's a little more conviction behind what's going on. We are continuing to drop off with the Ulcer Index, showing there's not a lot of fear. Here's another one, looking at it, sentiment. We're more at the midpoint here because they're using some kind of bands that actually adjust, so they're more dynamic. This is not giving an extreme reading at the current time, put out by Morgan Stanley. And we did get a reading from the Investors Intelligence. We're at 3.42, so we're above the 3 level, but not necessarily an extreme reading. We did go up with the closing value of the VIX when we look at the line chart as well as the bar chart. We're coming back up to these moving averages now as we're seeing a little bit of fear coming into the market. And with the down day, we also saw the VIX of the VIX continue to pick up in its speed. This is not on the table now. We spent a couple of days up in this red area with the SKU index, which uses out of the money options. It's kind of a version of the VIX. And this just meant that the market was expecting some kind of a big move. Well, we didn't really get much of a big move. The big move that we saw was really on Monday, but then we were still up in this area after that day. The last couple of days have been rather slow, but this indicator is now coming back down and not giving us an extreme reading. The momentum of the VIX continues to be higher as we're tending to chop, as we're going back up slightly when we measure it using the MACD. The equity put call ratio ticked up on the daily chart, and we continue to go up on the 5-day chart, which is negative for the market. The volatility risk premium still above this band, just showing that there is volatility in the market right now. So we're getting some different readings here. We're seeing the VIX quite low. We're seeing volatility risk premium quite high. And we're seeing some contradiction here where we see this VIX or this fear gauge going up with the other fear gauge going down. And a lot of this might have to do with either these negative divergences that we're seeing, or we're seeing some rotation into different sectors that is kind of skewing some of the results that we see. We did see an improvement here on a down day. The advanced decline line is showing a little bit of an improvement, but it has not broken out above this previous high yet, even though the S&P has. We're also showing a little bit more strength here when we measure this based on volume. We're looking okay here with our internals. We did see more new highs than new lows, even though it did drop off from the previous reading. So we're kind of going sideways with our 5 period. We're trying to go back up here with the 10 period. And we're trying to show a little bit of an improvement here with our 19 and 39-day advanced decline ratio. We're coming back above 0 in the short term, and we're just a little bit above 0 here with the red line, which is the more intermediate term. We came down just a little bit with accumulation distribution. This is a primary indicator to me, and we're above an advancing moving average. This means that the smart money is in buying. We declined a little bit here with the chicken money flow, but we're still positive. We want to see what happens after this. Is this going to continue to go down? That would turn things more negative. Now, we are potentially seeing kind of an extreme positive reading here. So this could see a pullback without necessarily turning negative. And the chicken oscillator is coming down after coming right up to this green line here. So that's getting a little extreme and now seeing some pullback that way. We did show an improvement here with our cumulative NYSE advanced decline line. We also turned up with our regular advanced decline line. Also, this other NYSE advanced decline line did bounce, and it's still bouncing off of its 50-day moving average. We saw a bit of a tick up with the common stock based on price as well as volume. And this is also could be taken as positive. We did see an improvement with the cumulative advanced decline line for the S&P based on price, but we have not surpassed the previous high yet. Where we are holding up better when we look at this based on volume. And we've been seeing that for the past few sessions. And we look at the S&P itself, that's the bar chart, and then the red line is the NYSE advanced decline line. We were starting to see more of a negative divergence here as the S&P was going up and the red line was going down. Now we're seeing this improve slightly. And we're seeing a little bit of an improvement here. Now, we're still below the moving average with our advanced decline line studies when we look at the common stock on the NYSE. We did go up even on a down day with the S&P, and it's still below the moving averages and kind of going flat and a little bit declining with the mid caps and the small caps. So in our daily chart, we're still looking pretty good here. We do have some overhead resistance. And when we look at this, we're still setting a series of higher highs and higher lows, even though this ended up being a down day. So that's encouraging when you just look at this price action by itself. On the bottom, we were above average with volume. We're still extreme, but coming down with the Stochk RSI. Also extreme, but coming down slightly with the Winners Percent R, as well as the CCI 14 and the CCI 20. We're still extreme with the stochastics and the short, intermediate, and long term. I like to point this out. This is a further subdivision of the short-term time frame. So we go short term, intermediate short term, and long short term. Looking at our double and triple exponential moving averages, we're still doing okay here. These lines are still going up. We're coming back down to these lines, but this is showing that the short-term trend continues to be holding for now. We actually went up a little bit with our 20, 50, and 200 period moving averages, even though we had a slight down day for the S&P. The force index did decline, but it's still above the midpoint and it's still positive. And our 20 period moving averages are well above them. And since we've been going up rather strong, we're starting to see the blue line, which is the exponential moving average, crossing back above more of the simple moving average, and it tends to move faster. This shows more conviction, at least for right now. We're still in the +3 channel with our standard deviations chart, so we're looking rather extreme there. And our boom indicator based on 20 periods, we're still just a little bit extreme, showing that we're kind of far away from the 20-period moving average. The 50, we're a little bit far away from that. We continue to improve with the 200-period moving average study. We're still looking okay with the balance of power. That's positive. The go, no go is still positive with the dark blue bars. We're still up at the blue line here with our highest high value, and we're above the midpoint. So that is still improving. The TTM squeeze has the lighter shade of blue, and it's going back up. That's positive. And with our 50-period double and triple exponential moving averages, the red line is starting to go back above the blue line. That's suggesting more strength in the intermediate term, and we're well above both of these lines. We're still extreme with the CMB composite, even though it has been coming down. The ease of movement is positive and advancing, so that's looking good. The Arun indicator, which is kind of its own little funky indicator, the green right on top, that means the buyers are in control. The red line means that sellers are in control when this is all the way to the top. Well, we saw a real pickup in the sellers, but now it's coming back down. We take both of those together to come up with this oscillator. When we're above zero, we are positive. And we're looking better here, even with a down day. The S&P McClellan oscillator is continuing to show some improvement. It would look even better if we could cross back above zero. So we're still declining, but starting to possibly flatten out a little bit with the summation index based on price and volume. Also seeing a little bit of an improvement here, but not quite as much with the NYSE McClellan oscillator. We're still negative since we're below zero. So the summation index for the NYSE based on price and volume continue to decline. This could actually be a little bit more negative. As we're declining here, we haven't surpassed this previous low based on price. We've already gone below it here based on volume. So that could be another little negative divergence to be aware of. The Swenlin trading oscillator showing some improvement. We're still negative here. We're slightly below zero based on price, or we're slightly positive based on volume. If this could continue to go up and both of these cross more convincingly above zero, that would turn back more positive. But the momentum, when you look at the PMO, still looking really good here, actually getting close to an extreme positive reading. We're still negative, but trying to turn up based on price, and we're still declining with a little bit more conviction based on volume. Saw a little bit of an improvement with the PMOs that are rising. The buy signals are starting to go up. We're starting to flatten out a little bit more with the PMOs above zero. We switched from being positive to neutral with the Elder's Impulse system for the S&P. We're still positive with the parabolic SAR with the dots underneath. The slope oscillator going further above this green line, above its moving average, that's positive, but we want to just be aware when we get above this green line. Now, I put the green line in here, and I like to say that there's nothing magical about this. I just kind of look at this and go, okay, that might be about a good place to put the line. It's just suggesting that we need to keep a little closer eye on this. The MACD continues to look positive. That's more intermediate term. All of our oscillators across the board continue to be positive now. We're still above all the plotted moving averages here. That's positive. This is a bit of a negative divergence. We are positive with the bullish percent index since we're above 50, but we're just chopping along sideways. We haven't really been showing any real conviction, meaning that there's not an awful lot of buy or sell signals being generated in the S&P 500 right now based on point and figure charts. We pretty much unchanged with the NYSE bullish percent index, but we're still above 50. And we're showing more improvement here after being negative. We crossed back above 50 with the NASDAQ 100 bullish percent index. The money flow is extreme positive, as is the ultimate oscillator. So this is confirming that we're looking extreme in the intermediate term. The vortex has the green line on top and advancing. That's positive. The RSI 14, that's more intermediate term. It's still extreme. We're also extreme in the RSI 9 period. That's shorter term. On balance volume ticked down a little bit since we had a down day, but we're still above an advancing moving average. We're slightly above 50 now with our 20-period moving average study of those stocks inside of the S&P. This is showing some improvement, again, on a down day. So we're seeing a little bit of life here. We saw this initial thrust up signal, and then some weakness went sideways. If we can see more improvement here, that might help prices continue to go higher. This is similar to what we saw back in March of 2023. A real thrust up, We chopped sideways for a bit, came down, looked like that signal might not be valid, and then we're able to break up out of that. We're wondering if something like that will happen this time. And we're turning slightly positive in the intermediate term. We crossed above 50 with those stocks above their 50-day moving averages. And we turned back up and went positive with those stocks above their 100-period moving averages. So even on a down day, we're seeing some internal improvements coming along here. And we're turning back up with those stocks above their 200-day moving averages. The momentum here is measured by the Copic curve is positive. We're coming down, but we're still extreme with the Sean trend meter. We're still above the moving average with our standard deviation. We were really moving along. And so the fact that we're kind of maybe chopping sideways, Tuesday and then Thursday ended up being rather slow days. We might have been moving a little too quickly. And we're still looking negative here, though. When we take the Amex, NASDAQ, and NYSE and do a 5-period moving average of the highs minus the lows, we're dropping further down below zero. We want that to go above zero to be more positive on a broad market basis. And we're still above this R2 level here on the weekly chart of the S&P. The thing is, can we close above this in Friday's session? That's what's really going to matter, because this bar is a weekly bar. And if we can stay above that with the weekly chart, because it's going to be the end of the week, and it's also, we're coming up closer to the end of the quarter, and Friday is going to be quadruple witching, where a whole lot of options are going to expire. And so it could end up being kind of crazy, but the last options expiration day ended up being pretty much a non-event. On a trending basis, though, with the Heiken Ashi, we're looking positive. The Kegi is still positive. The Renko chart is positive with the open blocks. The 3-line break is positive with all open candles. And we did have a new X drawn in here with the point and figure chart. So that is positive. When we got up to the 5,500 level, that put a new X in that's now green. This is looking pretty solid. We're still working off of a signal that was generated on May 15th of a double top breakout. Longer term, we're seeing a bit of a negative divergence here. As we were going up with the S&P, we're going down with the 150 and 200. We could be showing some improvement, though, with these moving averages. We have not seen a confirmation yet, according to the Hindenburg Omen, based on the S&P on top and the NYSE based on the bottom here. And the perma bears are just waiting to see if this is going to happen. But now, according to what I calculated, this hit on May 21st, 20 trading days would have been June 18th. We've now passed that. And this chart came out on June 18th. There's a 1-day lag with this actual indicator. So we'll have to see. But when we look here at the Hindenburg Omen for the NASDAQ, we've had all kinds of confirmations all along the way. But you can see we're getting confirmations here, and look what the NASDAQ did. So it ended up not really paying attention to that. We are still negative with the mid caps, and they are lagging behind, and that's a bit of a concern in the short term, where the small caps are now negative in the short and intermediate term, where everything else continues to be positive. According to the Keller market model, we're only negative now with bonds based in the long term when you look at them according to their price. Everything else is positive. No changes with the decision point scorecard. Everything is positive here. And we saw a lot of really nice positive signals when we started the day, and then we saw a little bit more red as things got a little bit weaker. And then we did see the S&P set a new 4-year high. That was intraday. We didn't close because we ended up closing down. The dollar going up, which is shown as positive here, it was actually a little bit more negative for the S&P. We're seeing the utilities now showing a little bit of weakness. They did a BPI cross below 80 after being extreme, where real estate is coming on, and they had a cross above 80. So, and then the NASDAQ set an all-time high. We had a bullish MACD crossover with the Dow, and we tried to get above 5,500, but we were not able to stay there. So the sectors, we had energy, which has been under pressure lately. It had a good day on Thursday. And utilities, which have been seeing some profit taking, saw some money coming back in there. And then, let's see, it was consumer staples, which is an area that we've been keeping an eye on. Real estate was actually down on the sector basis, and tech. And again, we're wondering, are things starting to turn more negative there? Or are we just seeing some profit taking right now? We're still looking okay with our score of the NYSE new highs minus the new lows. We're barely above zero right now. We want to get back above this to be more positive. And when we compare it to the equal weight, we saw a little bit of a decline in the ratio, but it's been the big stocks that have really been leading now. That's why we're seeing this ratio really going up. The Dow was one of the more stronger indexes. There was I almost said it. Shop force, works, whatever. One of the Dow components. It has the symbol CRM. I think that's right. I don't follow the Dow that close. Salesforce, workforce, whatever. It had a pretty good earnings report, and so that's really what pushed the Dow higher. We were able to get above the 50-day moving average and above this pivot point, but it's just been chopping sideways as the rest of the market's actually been advancing. When I say that, I mean the S&P and the NASDAQ 100. The diamonds continue to be positive with the Elder's Impulse system. The NASDAQ, we came up to this R2 level, and now we're coming back down. Is this going to be a problem here? We hit that, and we've not been able to at least close above it. We tried to peak a little bit above it there, but now it's starting to come back down. The NASDAQ 100, which was able to get above R2, now it's come back down below it. So we'll want to watch that on Friday. And we've gone from being positive over to neutral with the QQQs when looking at the Elder's Impulse system. The momentum for the NASDAQ 100 is still positive. The small caps have still just been languishing sideways, not really getting an awful lot of support there. They continue to be neutral with the Elder's Impulse system for the small caps. And when we look at the Russell 2000 small caps, we're still below 50 with the RSI. We're below the 50-day moving average. The long-term trend is still positive, but the shorter-term momentum continues to be negative. And the mid caps cannot seem to get above their 50-day moving average, and really causing a little bit of disappointment after being one of the stronger areas in 2023, especially at the end of January, taking us up higher and then leading us up in February. This was looking a lot stronger. Now it's like they've run out of gas or something. And we continue to be neutral with the Elder's Impulse system for the mid caps. And then looking at some individual Magnificent Seven stocks, Apple was coming down after seeing a really nice thrust up. We are changing over to positive here. We're seeing the 50-day moving average crossing above the 200. So that's looking more positive with the whole Apple intelligence announcement that's been riding the news and helping to send the stock higher. Tesla still really struggling above its 50-day moving average, but still in a downtrend. Nvidia saw profit taking of 3.5% after an explosive move that it's been seeing. Microsoft was down slightly, but still looking positive. Meta was up, and it's above its 50-day moving average. Amazon up 1.8%, but still not really breaking out yet. And Google has been chopping more or less sideways, even though it was up on Monday. See, I get this all mixed up. Oh, and the cat says happy summer to everybody here. But this is Thursday's session. Netflix is down almost 1% after looking a lot more solid. The FANG index is coming off of recent all-time highs. Financial sector showing some improvement here. We were getting a little bit concerned about this as we were dropping below the 50-day moving average. We saw 0.5% upward move, and we're back above the 50-day moving average. And we saw a little bit of an uptick with our staples to tech ratio. We want to continue to see this go down to be more positive. The dollar was up, which was probably pressuring stocks. And we're seeing a real disconnect between U.S. stocks and the rest of the world as the short-term correlation and the longer-term correlation continue to drop off. And I've added some new things here. This is the RRG, which I usually go through. This is relative rotation graph. And I go over this on a bigger picture look in the weekend videos. I'm now placing it on the different sector charts themselves. So we're still in an uptrend when we look at staples, and we're above the 50-day moving average. But when you look at this, the ratio, that's the red line, and then the momentum, that's the green line, they are declining, even though based on price. Now, this is comparing them to the S&P. That's what relative rotation does here. So we're This is just a little different way of doing ratios between sectors and indexes. We're also seeing some negative momentum and some negative movement here when we look at utilities as they've been coming back down to their 50-day moving average. Seeing a little bit of weakness here with healthcare. These are the defensive areas that we've been keeping an eye on. And energy is still bouncing off its 200-day moving average, but we're trying to turn back up here with the momentum. We're turning up after really declining here with the ratio. Just coming off of a recent high here with the total US stock ETF. We did go up with the 10-year yield, so we were down with the 10-year based on price. And then looking at our growth to value ratios, coming down, but still looking okay with the Qs to the S&P, still looking bad when looking at discretionary to the S&P, came down, but large cap growth is still outperforming large cap value. So with the large caps, still looking good there, coming down, but above the moving average, both with the mid caps and with the small caps. This is still hanging on and looking positive here with our 19-day advanced decline ratio. We're coming barely back above zero based on price, and we already came above zero based on volume, and we're staying there. So this could be showing some improvement in the S&P. So what's our outlook for Friday? We're positive. We still have these negative divergences that we're dealing with. They're not really going away, but we are seeing some improvements. And then we have to keep in the back of our mind, are we seeing some kind of sector rotation going on? And I'm trying to analyze the sector charts. That's the reason for the different indicators, but it's not necessarily apparent, at least yet. It will be quadruple witching on Friday, so all kinds of things could go crazy. We're going to get existing home sales and the leading economic index in Friday's session, and we want to keep an eye on the crazy things in the world. And here we will finish out the economic calendar for the week. I don't know about this MBNA mortgage applications index or the housing. I don't know if they're coming out or they're just going to delay it for a few days or what. Because with the day off on Wednesday, that kind of messed everything up. And we do have S&P Global U.S. Manufacturing and Services coming out. Not a real impact as far as what will happen. The big thing to watch for there is, are we above 50 with both of these? That will show expansion. Seasonally, we're kind of really not showing any decisive move here. We're neutral, excuse me. We're neutral to negative with the Dow and the NASDAQ, where we're neutral to positive with the S&P. We are finishing out options expiration week, where we tend to be up more than down, but be aware, the week after we tend to be down more than up, but it's not that big of a change. Friday is one of the more positive days based on what happened in 2023. We could be seeing some negative seasonality here with the green dashed line during an election year, at least over the next few trading sessions. This is another Carson chart where we're up here at the 21st. We might see some weakness here going from 1950 to 2023. And then we might see a bit of a bounce as we go further into the end of June. Tom Bowley has this more in the negative side. We're at the 21st now. So according to his research, up until the 27th, we will be negative seasonally. So our warning signs, we're still just keeping an eye on staples and utilities. We don't know if this really means anything. Is it different this time? Or is this a more defensive posture? Doesn't seem to be as influential as it was a week or two ago, but we still want to watch this. And we're also keeping an eye on energy, whether that's turning more defensive, and then healthcare, which is a defensive area. So we're watching that. The advanced decline lines, they're still negative and showing weakness, but they are showing signs of improvements. The equity put call ratio is up. The growth to value for the S&P has been improving, but not when you look at mid caps and small caps. And discretionary to staples, that's just not really breaking out. It's not falling apart, but it's not breaking out either. The McClellan oscillators and summation indexes for the S&P and NYSE, they're still negative. They're still below zero, but they are showing signs of improvement, especially on a down day. The Swenlin trading oscillator, it's still negative, but a good up day on Friday could actually switch this over to positive. And then looking at the positive side, the parabolic is positive. We're seeing a little bit of a pullback, but we're still positive with the accumulation distribution, the Chaikin money flow, and the Chaikin oscillator. The bracket means that I tend to treat these three as one unit. Our oscillators are positive. The bullish percent index is above 50, but it's just chopping sideways. The money flow, the ultimate oscillator, the vortex, the Copic curve are all positive. The financial sector, after showing a little bit of weakness, did have a nice day on Thursday. And when we look at the momentum for the NASDAQ 100 as well as the bullish percent index, we are positive. And our conclusion, we are positive, but these negative divergences are still there, but we might be seeing some signs of improvement. Now, that could be all wiped out with a down day on Friday, and we just want to keep an open mind to maybe some kind of rotation going on. In the short term, we're positive, but we're still extreme positive, even though we're coming down off of those levels a little bit. But that could also suggest good momentum. In the intermediate term, we're positive, but this is where we're seeing most of the negative divergences. And we're wondering if some rotation is going on there. In the long term, we are positive, and I actually added negative divergences here with the 150 and the 200-day moving averages. Thank you. I really hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.